Hey there, welcome to Market Insider. Today's the 19th of May 2016. We're back, and as usual we'll discuss what trades are in, how they're doing, as well as what's looking good on the horizon. So without further ado, let's discuss what trades we are in, and we're in Euro-Dollar on the weekly time frame. This as a result of a weekly bearish pin bar reversal at this 1-400 level last seen 2 weeks ago, and true to the conservative style of trading pin bar reversals, we simply traded the break of the low and placed our stop loss above the high. And this was a very simple reversal trade, simply top of the range here. This range has been forming ever since February 2015, and it made sense to really sell at this opportunity, which is the best price we've had in over a year, or a year and a half should we say. So it made sense. We had the false breakout 2-3 weeks ago, characterized by this tail above the 1-500 level and the open and close below this horizontal level. So we are armed with two choices as to how to take this trade. We could have taken it at the midpoint here as per our advanced pin bar reversal rules of our stop loss above the high. However, as you can see here, we didn't really have much overlap in price on the previous weeks at the midpoint, so we decided to take the break of the low with our stop loss above the high. Furthermore, in support of this trade, we had bearish reversal divergence, as we see on the RSI setting 6. We've got a lower, or had a lower high here, whereas price made a higher high. That was a sign to us that there was less strength in the buyers coming into the levels, so that was an additional factor in favor of our sell prognosis here for Euro-Dollar. So beginning of last week we were triggered into the trade, and this week we are well and truly in the trade, and we're at the point now where we have moved our stop loss to break even. Remember, we risked about 250 pips on this trade. First target, I'll say midpoint. If you wanted the high probability, lower reward outcome, you could start scaling out at the midpoint, or indeed you could scale out at the previous swing low, just below just above 1.0600. We've got decent reward to risk here. We've got 833 pips divided by 250, that is 3.3 to 1, risking 1%, or if you're risking 2%, that's 6.66% potential profit if you decide to take the trade all the way to the bottom without scaling out. Of course, if we look at the bigger picture here, we can still see, looking at the monthly here, that Euro-Dollar is in a projected downward trend here, and we've had a year of consolidation, range-bound markets, and one could argue that now it's a time to potentially see more movement to the downside. Remember, we've got parity just below this level, our first target, 637 pips away, roughly speaking. So we've got a lot of movement in the can for Euro-Dollar. If it breaks this horizontal level, then fantastic. If you're too late for the trade and you're not in it, then that's unfortunate. But what you could do is simply wait for a pullback on the weekly or indeed the daily time frame, i.e. we get an extension and we get 2 or 3 bar retracement and a bearish pin bar reversal. We could take advantage of that prior to an extended leg to the downside. Or what we could do, if you're not in this trade, is hold tight, sit on your hands and wait for it to come down to this level. If it breaks this level, which, well, face it, the odds are in our favor for breaking up the level, given we've got the order of the moving averages with the 20 below the 50, the 50 below the 200, then what we can do is, if as and when this level breaks, sell the retracement if as and when price comes back up to test it where this support level becomes resistance prior to an extension to the downside. Remember that parity here, this one where $1 equals €1, is a psychological line in the sand. It's a big psychological number, and we could reasonably expect quite a bit of support at this level, bearing that in mind. Okay, so that's Euro-Dollar. Moving on to our old friend Pound Swiss, which has been so dear to us over the past 6 months. We're out of it. Unfortunately, it was a great 15-20 weeks we spent in the trade. However, all good things must come to an end at some point, but we were able to make good profit of it. We did have a sell signal about 3 weeks ago. We had this bearish pin bar reversal testing this horizontal level as resistance, and we were anticipating continuation to the downside despite the break of this trend line resistance. However, what happened after we were triggered into the trade 3 weeks ago, this bearish pin bar reversal, after we put our order to sell at the break of the low with our stop loss above the high, is the week after we had the formation of a bullish pin bar reversal, which is not what we wanted, and of course that spelt danger with all the red flags flying high. So what we did, we decided to manage it and avoid a full hit. It's never convenient when that happens, and I know it's very easy to be in a state of denial when it does happen, but we just need to appreciate that the market can do anything at any time, and as traders, our job as well to lock in profits and of course first and foremost keep our account or preserve our capital, should I say, is to minimize losses. And if we get in a downward market where we're looking to sell and we're in a sell trade, as a result of a bearish pin bar reversal, if we get the formation of a bullish pin bar reversal, then that is a big red flag. So we decided to manage it by simply moving our stop loss, which was at the high of this bearish pin bar reversal, to the high of this bullish pin bar reversal. So when we were triggered into that, we were stopped out, fortunately at about 0.6%, risking 2% on this trade, so 0.6% loss on the trade, which was just as well because this has happened this week, okay, which is never really convenient, but fortunately we've saved ourselves a good amount of money through eliminating further losses in a trade setup which is frankly now invalid. Okay, so what is happening now with pound Swiss? Well, let's take a closer look. Let's go down to the daily time frame and take a closer look. So here we've got, as we can see, the formation of an inverse head and shoulders. We've got the left hand shoulder, the head, and the right hand shoulder here. Or is it? Well, we can confirm that the neckline has been broken, as has been the case for the past 2 days. We've got the close above it, but what we can tell you, even if it is a bullish inverse head and shoulders, is the fact that we've got the completion of a complex, or we've got a near completion, sorry, of a complex retracement in the form of an ABCD free wave harmonic pattern. And we've got A, B, C, D. And what is interesting about that, we haven't got the completion of it yet, but if we do, if as and when we do, this completion of this free wave formation, A, B generally equals C to D, and the completion of D point coincides very nicely with this 1.4600 horizontal level here. So what is significant about that? Well, this could be a very powerful barrier in obstructing price from going up any more. Remember that this ceiling, if you like, level of resistance could thwart price, and it corresponds with a big round number, 1.4600, 00, psychological round number. It correlates with a previous level of soft resistance. You can see it's been tested several times before. Does it correspond with a Fibonacci retracement level from the very start of the move here, all the way back at the beginning of December? Let's find out. Okay, not quite, unfortunately. It would be very handy if it coincided with the 50% Fibonacci retracement level from the very start of the move here to the end of the move before the retracement. However, what we could see, given that we've got overshoot here, we could get the overshoot of price on the weekly or the daily time frame, and this area here, this zone, should I say, between 1.4600 and the 0.618 Fibonacci retracement, this could form as a potential sell signal. Okay, and this could manifest itself as a bearish pin bar reversal on the daily or the weekly time frame. We could see it as a engulfing bar on the daily or the weekly time frame. We could get a double inside bar on the daily or the weekly time frame. Essentially, we're looking at this zone here as a potential turning point for further downside action. And if, as and when we do get it, we'll look to trade it. We'll also look to see if we have a reversal on the smaller time frame at this point, and or bearish reversal divergence on the stochastic setting 833 or on the RSI setting 6. So this level is one to watch for the moment. It's not quite ready yet. We've got steep, quick, aggressive retracement here, and essentially no trends are perfect in this sense. The trend overall, by and large, if we look at the monthly time frame, let's zoom in a little bit more. We've only got about 6 bars. You could argue here that on the monthly, we've got this doji bar last month and the high has been broken, so we've got an overshoot at the bottom of the range. It could be coming back up to the top, but remember, we've got this thing called Brexit coming up, and if we do have a sell signal at this efficient price point at one spot for 600, then that could be a very decent point at which to sell and make potential profit in this sense. Okay, so do bear that in mind. So now let's take a look at oil. We've been long on oil all the way since February, and we've made a significant gain on crude oil long, and really picked this bottom quite well. So we've been in this for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 weeks, enjoying incremental gains over a longer period of time. Now we are approaching a key psychological level for oil, and that's the $50 a barrel level here. At this point here, this horizontal level of resistance is also a psychological number as well. What is more is its completion of an ABCD pattern as well. So this is where we need to take note for those of you who are still in this trade long. We've got this trade at the ABCD pattern completion point, which curiously enough, if you see A to B generally equals C to D, A to B equals C to D is generally the same distance. You can see that the A to B, C to D free wave harmonic pattern completes at the $50 a barrel level, and this is exactly where price is just shy of. So we're taking note here, and we're looking actually at potentially scaling out of this one here. Remember that oil has fallen all the way down from $110 a barrel seen at the high of 2013 all the way down to about $25 a barrel. So you've seen a huge fall to the downside, but if you look at the screen here on the weekly chart, we're still got the sell bias overall. Remember that the moving averages confirm this with the order and separation between them. We've got the 20 below the 50, the 50 below the 200, and what we could argue is the past 15 weeks worth of price action after our reversal is nothing more than a complex retracement. Or is it? We don't know. What we do know is that we're in a seasonally bullish time for oil, and we've got a few more months in the can left for this bullish formation to take place, or this reversal to take place. But $50 a barrel is roughly half price of the initial high. So what we're going to do is potentially look at, on the daily, waiting for a retracement to test the 20 moving average here. Remember, the 20 moving average has acted as dynamic support once, twice. Could it happen again? We're just waiting for a retracement on the daily, and then we would look to get long if we do get a bullish pin bar reversal testing the 20 moving average on the daily. However, on the weekly, what we could see is a potential opportunity to hedge our existing long trade at the moment. So if we get this bearish pin bar reversal, we could see this as just a mere ricochet just shy of $50 a barrel. It just reached $48 a barrel, which is just shy. Remember that price doesn't have to necessarily hit the price in order to test it. It could just be shy of it. And if it closes as a bearish pin bar reversal just shy of $50 a barrel, and we've got the completion of the ABCD pattern into this level, we've also got bearish reversal divergence here on the RSI setting 6 as well. Furthermore, we've got it on the stochastic setting 833. For those of you who just want to recap, bearish reversal divergence is where we see a disagreement with the stochastic making a lower high, or indeed the RSI setting 6 making a lower high, compared to price, which actually makes a higher high. It's a sign to us that the bears are essentially creeping back into the market. So what are we going to do in this instance? Well, if we do get the close, the bearish pin bar reversal on the weekly, a good hedge would simply be to sell at the break of the low with our stop loss above the high, just in case. If we do get the setup for a long on the daily, then certainly we could see next week close as a bullish pin bar reversal, and we could trade manage this accordingly, just in the very much the same way as we did with pound Swiss. So if we're triggered in for a sell on the weekly time frame with our entry just below the low, stop loss above the high, and next week closes as a bullish pin bar reversal, we know that that was a false signal, and we can just simply get out of the trade at a small loss or a minimal loss. Okay, but it's always good to be adaptive as traders, and even though we might not have seen the reversal all the way back up to $60 or even $70 a barrel, we've actually done pretty well on this one in percentage terms. We made 1, 2, 3, 4, about 5 to 6%, risking 2% over the course of the past 4 months. Okay, so we've got options with oil. We've got a potential sell on the weekly. We can cover our gains on our weekly long, and we can potentially look out for a long on the daily. Okay, so oil is at a bit of a hiatus at the moment. Just moving on to the FTSE, you've heard the old expression, sell in May and go away. Well, we had about 3 weeks ago a sell signal on the FTSE for a sell, and we took it at the break of the low. Let's just simulate this one. So we took it here at the break of the low of this weekly, testing the 6400 level, and we've been short ever since. If we take a bigger look at the FTSE here on the weekly, we can see that we've got potentially more downside action to take advantage of. We can take just below the 6,000 level here as a potential take profit zone, i.e. scaling out of the trade and leaving half the remaining half to run. Remember that as Brexit is coming up, like I keep mentioning, and we do get the referendum verdict as to leave the EU, then it's very likely that the FTSE will tank, and so too will the British pound. We no longer have exposure to the British pound short. We have been short for many months, 6 months plus, and we have exited off the back of retracement, like I mentioned when talking about pound Swiss, but we still got exposure to the FTSE, which is no bad thing. Remember, we are looking to get back into the pound short if, as and when we get the completion of the ABCD as mentioned earlier in the webinar. But for the FTSE, we still got exposure, so we moved our stop loss to break even, and we're just going to enjoy the ride. Okay, so there are the trades we're in addition to what further trade ideas we could get off the back of the bigger moves with those trades, as mentioned, oil and pound Swiss. So what else is there out there? Well, taking a look at Euro New Zealand on the weekly, we did last week have the close as a gravestone doji, also can class as a bearish pin bar reversal really. It's about to got a slight overlap between the open and the close, so we could put a limit order in at the break of last week's low with a stop loss above the high and take it to the previous swing low as your first target. We've already got exposure to euro dollar short, and this one, quite frankly, we didn't really have the reversal on the smaller time frame or bearish reversal divergence, so we didn't take this one at the time. However, if we look at the smaller time frames now, we do see the breakdown of this movement upwards to this horizontal level just shy of 1.700. As you can see here, break of this trend line, and it's been just inching downwards ever since. So that validates that trade idea really. There are better trade ideas out there, as already mentioned. The lack of reward to risk longer term does essentially reflect to me that it's good to keep our gunpowder dry. Also, this is inside a triangle which is moving sideways. One could argue, as we're still 25% away from the apex of this triangle, that we could see a break to the upside or to the downside as we're at the top or towards the top of a longer term movement down. Then we could argue that there is potential for more downside action, but we need to wait for the break of this triangle before we can really see if it's got any conviction at all. But by and large, we are in a state of retracement for a lot of the trending pairs, so for that reason we're not really in any rush to trade anything else. Remember, we've got about 3 trades open at the moment, and we've got several on our watch list. We've got Euro New Zealand, we've got oil on the watch list for a weekly sell and a daily buy. Just incidentally, going back to oil, what you could do if you're long on oil at the moment is move your stop loss below the high of this week if it closes as a bearish pin bar reversal, because if we do get the break of the low to the downside, then that validates a short move which has decent evidence in favor. Okay, so there really isn't anything else to trade. Remember that trades are like buses, so too are winning and losing outcomes. All right, the skill set is for many traders is to simply have the ability to know when to stay out and sit on their hands and just say, thank goodness I'm staying out, I'm keeping my powder dry, to until we do actually get some decent setups. So there is absolutely nothing wrong with staying out of the markets. If there's nothing really that looks of interest to you, then preserve your capital and have faith in your conviction for doing so. Don't listen to anyone else out there, because it's likely they're not trading your strategy, they're not viewing the market in the way that you are or we are, and you have no idea how profitable they are or not. Okay, so by all means, embrace this week, if you're not in any trades, as an exercise of patience and discipline. Remember, we're lazy traders. We don't have to force trades. When I say we're lazy traders, we're also professional traders as well. So we need to really be careful, disciplined and patient, and not succumb to the temptation of just trading for trade's sake, because that's what amateurs do, and you haven't come this far to really model them. Okay, so if you have any questions on anything we've discussed in this cast, please drop us a line at tradingfloor@thelazytrader.com.